Yo, what's going on? Um, in this video, I'm gonna be teaching y'all how to trade the same way that I do. Just in case anybody was wondering, um, the way that I trade, I can go ahead and show you some stats right here. Um, Win rate. All right. Now my win rate is usually around 50%, but I did go on a crazy losing streak last week, so it's cool though. I'm not really tripping. Um, so 45%, but that's with last week. It's usually around 50% win rate, but my risk to reward factor is usually around 1 to 2, all the way up to 1 to 5, 1 to 6. I've hit 1 to 10s before. So let's go ahead and get into it. First thing you want to do is go ahead and go on traderscasa.com. It's a really good free website that you can use in order to back test different types of strategies, just in case you wanted to you know what I'm saying, you wanted to back test. All right, you're gonna click back test, new session, just name it whatever, scroll down, whatever one, S&P 500 or NASDAQ, either one works, does not matter. Let's just go ahead and go January 2026. All right. Alright, now there's a couple of different things that I look for. I'm going to be showing you my setup without a few confluences and things that I look for, but there's certain things that I would see in the market that I would heavily impact whether I would take a trade or not, or if it would just, reaffirm the trade that I'm taking to make sure that it's, even better. So first thing you want to do is high time frame is so important. You always have to look at the 1 hour or the 4 hour. And the first thing I look for is a fair value gap. Now a fair value gap is I'll go ahead and show you. So do you see how where my cursor is, right? You see how all these candles are overlapping each other? And then what's the difference between all of these and then these two? You can see it leaves a gap. What is the fair value gap? Fair value gap is a space of liquidity that price can either reject or inverse. And this is an extremely good confluence that is very vital to, what I use in my setup. So how to mark out a fair value gap. Now you go right here on this sidebar. Looks like a lot of different things, right? But you click on this little this brush. Don't click on it. Click on the side arrow. Then you scroll down. You look for a rectangle. Now at the top of this gap, you would click. Go all the way down to the bottom of this wick right here. Now this rectangle will make it a lot easier to see where the gap actually is. So you can clearly see that it's from this candle to this candle, and this in between space where this green and this red are not overlapping is a fair value gap. So now that we have that, we want price to, go into this gap. And what it can do into this gap is it either respect it, which means when it respects it, it can, since it's bearish, this is a red candle, it's supposed to go back down off of this liquidity, go back down. What is liquidity? I forgot to say that. It is resting buy or sell orders over a high or a low. So liquidity could be, up here or behind this low right here. It is resting orders above or below a high or a low. So yes, that's what liquidity is. Now, once we have that, I want to see price. All right, there we go. Now price went into this gap. We're not going to be trading on the 1 hour. I just want to see price go into this gap. From that, we could scale down to the 5 minute. We'll only be taking trades on the 5 minute, right? So, first thing I look for is a liquidity sweep or a fair value gap. It depends which one it is. So, I know a lot of people view liquidity sweeps like this. Like this. A lot of people view them like this, where price sweeps down lower, and that is like an action move. But there's a way that you can look at this with just one candlestick, if that makes sense. So if you can see this candlestick right here, right? You see the lowest point this wick has gone was right here, right? But the candle closed up here. This wick went all the way down below these two candles right here and swept out both of these candles. Not only did it do that, but if you see this is a bearish fair value gap that price inversed off of another bullish fair value gap. I'm going to explain it all, but that would be a liquidity sweep, and that is the number one thing that I look for getting into a trade. So, okay. So as you can see, we have pretty much the same exact thing, but a bearish one right here. But let's go ahead and click play. Okay. Now, what do we see right here? We can see the same exact thing, but off this green candle right here. So you can see that the lowest point was below these two candles, and then price pushed higher, inversing this gap. Now that makes this high time frame gap, this high time frame fair value gap, let me put it as it makes this an inverse fair value gap. Now the only thing I would look for, right, this would be a complete setup right here. It's extremely simplified. So we have another fair value gap right here, but this time it's bullish, it's green, it's going up, right? And it already closed above this bearish gap. So if it closes below a bullish gap, then that's an inverse fair value gap. If it closed above a bearish gap, then that's an inverse bullish gap. So now that we have this liquidity sweep into a fair value gap, that would be the number one thing I see. And we also have another bearish gap right here that we inverse as well. I would go ahead and place my trade right here and then go below all of these gaps, because usually price likes to retest down lower into these gaps otherwise than shooting higher. But if it doesn't, then it'll just go straight up. The only reason this trade would not work out would be because of this gap right here. If you can see that, that would be the only reason. Now you can take a scalp and enter multiple contracts if you wanted to, just to take a trade to right where my cursor is below this gap. Now I think that would be almost a guaranteed setup right there. But you know how the market is. Nothing is guaranteed, but that would be an extremely good A+ setup with no drawdown. Or if you wanted to be a runner, which I think off of this high time frame gap, inversed gap, that it can run a little bit higher and inverse just a simple 5 minute. So let's go ahead and see if I'm right. And I was right. So that is exactly how I trade, and that is exactly how I take my trades. Like, it is extremely simplified once you get the concept of multiple different things. Now there's a multitude of different things that I use that are not just this, right? But this is my main base. This is the base of like a base concept of what I use to take my trade. I wouldn't need anything else to take this A+ setup. But if I had a break of structure, which you can see, there's higher highs and higher lows, correct? You can see we're in a bearish trend. we have lower low, higher low, lower low, higher low, lower low, higher low, continuously going down, correct? And then the same thing, lower low, higher low, lower low. Now, when you get to right here, off this trend line, you can see right here that price off this inverse gap right here that we just took, that this trend line going lower, so it's going down, lower low, higher low, lower low, higher high, higher high right here. So this right here is what you would call a break of structure. That is a break of trend. That's a breaking of trend structure. So as you can see, if price was going, follow my cursor right here. If we're going higher high, higher low, higher high, higher low, higher high, and then we plummet down to a lower low, that is called a breaker structure, and you would see that it's going to the downside. But in this case, it is going lower low, lower high, lower low, lower high, and then higher high. So that would be a perfect example of a breaker structure, and that's another confluence that I would use in my setup to take my trades. Now, another thing that I use is SMT divergence. So I can't do it on here, but I can show you guys live. I don't know if we have any. I don't know. Let's see. Let's see. Okay. All right. I don't think we have any. Oh, no, we do. All right. Right here. If we mark out this high right here, right? Since S&P 500 ES and NQ NASDAQ are correlated pairs, correct? They want like one pair is obviously going to follow the other, right? A leading index. So as you can see right here, NQ made a higher high, or I'm sorry, yeah, no, it did make a higher high. So then you go back to ES. Oh, I did the same thing. Shit. Never mind. I guess that's not SMT. Let me see. It's on the 5 minutes. See if we can find any on the 1 hour. Okay, there we go. All right. You can see right, and higher time frames are everything. You need to look at the higher time frames for literally everything. Okay. Now, you can see that NQ is the one lagging here a little bit because off these two candlesticks right here, you can see that NQ went a little bit lower while ES went higher. So since they're correlated pairs and NASDAQ is the one lagging behind, you can make a fair assumption to say that NASDAQ is also going to go higher, because if you see ES is going higher, is continuously going higher, and NASDAQ is going a little bit lower, then that is the lagging index, and you can kind of take your trade off of, the same trade that I just took. But if this trade had some SMT where I can see right here that, let's say at this high right here, NASDAQ went right here, and then let's say ES was right here, and we are going into a bearish gap, or we are going off of, a bearish gap right here, then we can clearly make a fair assumption to say that NASDAQ that is all the way up here and ES that's all the way back down here, that NASDAQ is going to continue lower because that's where ES is going. So they're both correlated pairs. That's why you have to, be cautious with the trades that you take, because if you don't look at both pairs and both indexes, then your setup could be blown up. So like, let's say that, let's say right here, let's say I took the trade right here, right? And everything is good. Let's say this fair value gap is not even right here, and everything looks good, no drawdown on a trade. And then you go on ES, and there's a huge fair value gap about this big, you probably would not want to take that trade just because they're correlated indexes. ES could reject off of that huge gap and send NQ flying back down. So that wouldn't be a trade. You would rather wait for this gap to get inversed in order to take that trade. If that makes sense. I'm kind of going very fast and I'm talking like Chinese right now, but there's a couple videos that you can watch for, strictly like beginner friendly, super, not complicated, or as not complicated as possible, but I'm kind of going through this a little bit fast. But I'll go ahead and, this video is more so like if you've already watched multiple videos and you're going through strategies and you kind of know what confluences to use, or you already know what confluences are and you understand them on a basic level, this will be better for you to find out. So okay, we're back on the 1 hour time frame again, right? So first thing I do is, of course, mark out a higher time frame fair value gap. So this is bullish this time, so we'll mark it out as green. That means price is supposed to reject this and go up. But if it doesn't, then it'll make this an inverse fair value gap and then shoot down lower. So we'll go ahead and see. What we have here. Alright, now I'm already seeing something right here. So do you see this gap right, or this liquidity sweep right here? This gap closed below 1, 2, 3, and 4 different candles. All 4 of these candles it closed, or I'm sorry, it didn't close below, but its lowest point swept all 4 of these candles and then closed above them. So that's the number one thing we look for, is that liquidity sweep, right? And then we have this fair value gap right here on the 5-minute. Now, what did price do to this gap? Price closed, this candle right here closed above this bullish gap, making this inverse fair value gap right here. Okay, so that made that an inverse fair value gap. Now the only reason why I wouldn't take this trade, right, would be because of this gap right here. It's a very big gap. So what I would do in this situation is I would wait for another candle close. Ooh, let me mark this out as red as well. I would wait for another candle close above this gap in order for me to take this trade. So let's see if it does. It does not. That's exactly why I would not take this trade. So let's see if we can get anything else. Whoa. Let's see. Okay. Now, since price inverse this gap, you can clearly see that this huge candle right here inversed it, right? We'll go back on the 1 hour. That is exactly why. Okay, let's see. Let's mark out all of these fair value gaps right here. Alright, now we're going to go back down to the 5-minute. Alright, so this is perfect, basically. So what we can see right here is all 3 of these high time frame gaps, bullish gaps, got inversed. That is a extremely good sign that price is going to continue down lower. Now, I wouldn't take this trade yet because I don't see a setup on the 5-minute. So we're going to keep on playing. Let's see. Now, we see multiple different fair value gaps on the 5-minute, right? But we see no liquidity sweep, so I wouldn't take this trade. Now, no, I still wouldn't. Alright, let's go ahead and get rid of all of these. Because at this point in time, I don't think it would be good enough to take a trade. And that's another thing that, a lot of people have to, understand that sometimes not taking a trade is the best. Preserve capital. So number one thing you want to do. Okay. Let's go ahead and mark out this other fair value gap on the 1 hour. And you can also use the 4 hour as well. Forgot to say that. Yeah, you can use the 1 hour or 4 hour. I just think fair value gaps form, at a higher rate on the 1 hour. So 5 hour. Or I'm sorry, let's scale down to 5 minute. Oops. Alright. Now let's see if we can find anything. Now, since we're in a bearish gap, red, it's supposed to go down, right? So one thing that I'm looking at right here is I'm seeing a higher high, higher low, higher high, higher low. Excuse me. So that would mean this is a trend right here, right? So since this is a bearish gap, what I would want to see is the same liquidity sweep into a fair value gap or inverse fair value gap, breaking this structure. So higher high, higher high, blah, blah, higher high, higher low, higher high, higher low, so on and so forth until we create a lower low past this trend line. So let's see if we can, because we already have one liquidity sweep right here. It swept both of these candles out. Now let's see if we can get a fair value gap. Doesn't look like it. Yeah, does not look like it. So I wouldn't have took any trades. Okay. All right, perfect. So we have a liquidity sweep right here. This gap this candlestick swept out both of these candles. Actually, all three of these candles. It inversed. Hold on, let me get rid of this first. It inversed this bullish candle, making it an inverse fair value gap, meaning that it went from green to candle. It went from a green bullish gap to closing below under it. So that's a good confirmation that we're going to go down. But not only do we have one, we have two. And that's just on the inverse fair value gap. We also have multiple of the bearish ones as well. So you can see right here, I probably would have entered and put my trade around right here under this fair value gap, or I would have put my position right here because this was off this inverse gap as well, and then put my stop around all three of these fair value gaps. That way we have good confirmation and we can run all the way down to around right here. Why did I put my stop right here? It's quite calculated. Go back to this inverse or this fair value gap. You can see there's one right here. Price rejects off this gap right here. Usually that's what it does. So we're gonna put our stop in for a 1 to 2 risk reward. So if I put in $100, I'll be getting $271. It's 2.71 risk reward. So as you can see, mostly this trade played out. But let's see if it hits TP. Oh, it ends up not playing out for TP, but that's perfectly fine. Because it's still a really good trade. And that's pretty much all we really need, because not only did we have all of those things that I just talked about, you can clearly see that we broke structure as well. So if this trade doesn't play out, that's perfectly fine. We were more than halfway into the trade. I definitely would have went break even at this point if it was a live trade. So I just would have made no money on the trade. So that's pretty much it. Alright, I'm going to do one more and then I'm going to hop off. I'm going to hop off, man. Alright, as you can see, what did this do? This candle closed above this bearish gap. So, what does that mean? What does that make this? That makes this an inverse gap. So we would be looking for longs now to go higher. So let's continue to play this. I don't know if I like that. don't know if I like that either. Let's see. Alright. Yeah. I don't think I like any of this that I'm seeing, so I'm gonna go ahead and delete this right here. Now, what price does like to do usually is off this inverse gap, it goes higher and retests it. So price will go higher and then go back down into that fair value gap and shoot up higher. That's what I call a retest. All right. We see this little gap right here. Mark that out, unfilled. We see this gap right here. And then we also see this gap right here. I can tell you right now that all three of these look like they're about to get inversed. That's good confirmation going lower. But we see no liquidity sweep, so will we enter? Probably not. Okay, this is the liquidity sweep, or this is the retest that I'm talking about. So as you can see, price inversed and closed below all three of these bullish gaps, right? So once they close below this gap, you would think it would continue down lower because it closed, below all three of these. But this is what you call a retest. So it shot through all of them, went higher, retested it, and I can tell you off this liquidity sweep, I'll go ahead and enter my short right now. I'll probably put my stop around right there, this midline of this bearish gap right here. But really, I don't really need my stop loss that much. Honestly, I can put it to right here, and then put my stop at this low right here for a 1 to 5, 1 to 5 risk reward, and then I lost. But I do have 50% win rate, so it's fine. And you can clearly see that all three, this price went right back through them, so that just makes these gaps invalid. So they're once it's inversed and it goes back through the gap, you cannot use it anymore. So either way, it would have lost, so it doesn't matter. Market does what it does. 50% win rate, as long as you keep, your risk to reward 1 to 2 or higher. I mean, you're going to be profitable, but you also have to, manage your emotions. And that's something that I can't teach you. It's something that you're going to have to teach yourself. So, yep, that's all I got for y'all today.